Even the most beloved brands eventually collide with hard mathematics. Right now, the ultimate bellwether of the Philippine stock market has collapsed to a 5-year low, occurring even as visible consumer demand remains immense. This waterfall chart breaks down the first quarter of 2026. The massive block at the top represents record-breaking revenues of 76.5 billion pesos. But as we move down the ledger, the cash is chipped away by rising expenses, leaving a microscopic sliver of just 1.47 billion pesos in attributable net income at the bottom. That is a 38.8% plunge. My name is the operator. To survive the current exchange, we must surgically separate our cultural affection for this brand from the mathematical reality of a bleeding balance sheet. The problem here is the opposite of a lack of customers. System-wide sales actually increased by 10.3%. The dining rooms are full, and transaction volumes are higher than they were last year. Jollibee is suffering from a systemic disconnect between generating cash and actually keeping it. For the rest of the Philippine consumer sector, this is a loud institutional warning. To understand margin compression, look at the pressure created when the cost of making a product outpaces the price charged for it. In Q1, Jollibee reported an 11.7% surge in direct costs, which effectively crushed the gains from their sales growth. Specific agricultural commodities are driving this spike. Shipping disruptions inflated poultry feed, heavy rains triggered a sugar deficit, and tensions spiked imported wheat costs. Domestic inflation is compounding the problem. The price of rice, the primary side dish for nearly every Jollibee meal, surged by 13.7%. No fast food empire can outsell bad unit economics. When the input cost of every meal outpaces the menu price, record high sales volume only serves to accelerate the company's financial losses. To find the origin of this cost spike, we have to pull up a geopolitical map. These pressures trace directly back to the 2026 Iran war and the closure of the Strait of Hormuz. This shock was transmitted instantly because the Philippines imports 98% of its oil from the Middle East. The conflict forced the government to declare a state of national energy emergency. Here on the ground, diesel prices reached over 140 pesos per liter. For a company with an extensive delivery and distribution network, that single number decimates operating margins. The energy crisis drove up the cost of nearly every item in the consumer price index. By April 2026, Philippine headline inflation accelerated to a 3-year high of 7.2%. This pressure created a sector-wide contagion. Shakey's Pizza reported a 20% drop in core income, proving that the entire consumer discretionary space is struggling to breathe. Jollibee's 39% profit drop is a mathematical casualty in a geopolitical domino effect, spanning from the Strait of Hormuz directly to Manila. This environment creates inflation fatigue. When core expenses like fuel and rice surge, consumers are forced to radically alter their spending habits. While discretionary stocks like JFC and Shakey's are seeing a bloodbath, consumer staples are acting as a safe haven. Pure Gold reported a massive 23.7% surge in first quarter net income. This market divergence is driven by a shift in psychology. Tapped-out consumers are trading down from restaurant dining toward value-focused bulk grocery shopping at warehouse clubs and supermarkets. In a high-inflation environment, the market reallocates capital from wants to needs with brutal efficiency. Investors must adjust their portfolios to match that reality. Management is currently in a defensive crouch. They are reviewing global expansion targets, slowing down capital spending, and implementing measured price increases on the menu to defend what remains of their margins. This creates intense tension on the trading floor. Wall Street analysts are maintaining a strong buy consensus with an average target of 281 pesos, yet the stock price has collapsed below 140 pesos. Applying the Alpha protocol requires a clinical assessment. You must weigh the risk of a prolonged energy crisis against the opportunity of a dominant brand trading at a deep discount. Open your Blackout Ledger and decide, is Jollibee a generational buy-the-dip opportunity or a deadly falling knife to be avoided at all costs? A cultural icon's survival ultimately depends on whether its business model can endure the ruthless mathematics of a